Hi everyone and welcome to the Patient Wallet channel. In today's episodes, I'm going to go over the earnings reports of Microsoft, Google and Amazon. I'll share the key highlights and gems that I found during this process, show some comparisons to help you digest all of this information, and stick around to the end of the video to find out which is my strongest stock conviction today. Like the video, subscribe to the channel, and as always, please do your own research before taking any financial decisions. Starting with Microsoft, the report was business as usual. Microsoft is a great company and reported a great quarter. They beat on both top and bottom lines. Azure grew by 40%. Management is planning to double their cloud capacity by 2027 and increase their AI capacity by 80% this year. During the Q&A, there were some interesting questions, but I felt that management didn't provide real answers. One of the questions that I think was key was around how management is making the decision to take on new clients or not, and how they make sure that promises are being made by potential clients. A question that I personally have about OpenAI is how an unprofitable and cash-burning business is going to be fulfilling all of these contracts and deals that they're making today in the markets. Revenue was $77.7 billion and increased 18%. Operating income was $38 billion, increasing 24%, and diluted earnings per share on a GAAP basis was $3.72, increasing 13%. One of the key data points that was highlighted during the earnings call was their commercial remaining performance obligations, which stood at $392 billion as at the last quarter, and the management highlighted that the weighted average duration of these contracts is just 2 years. So Microsoft is expected to realize this $392 billion in contracts over the next 2 years, which is massive. And as we can see from the chart, the stock price popped earlier in the week, which I think is due to the OpenAI deal that was announced. But after earnings, it went down, finishing the week with a negative return of 3.6%. Next up, we have Google, and the way I would characterize the last earnings report is that they made it clear that there is no AI race when it comes to Google versus OpenAI. They beat on top and bottom line. It was their first $100 billion quarter in revenue. Gemini has 650 million monthly active users. Search as a business is doing fine. Paid clicks are up. AI overviews monetization is around the same as the older search format. A new search format, including the AI overviews and AI mode, is expanding the market, which is positive for Google. Their revenues increased by 16% to $102.3 billion. Their total operating income increased by 9%, and their operating margin was 30.5%. Lastly, net income increased by 33%, with earnings per share increasing 35% to $2.87. This chart shows the search revenue on a quarterly basis, and as we can see, quarter on quarter, it grew by around 15% and stood at $56.6 billion, which suggests that this business is doing absolutely fine. A couple of months back, the narrative was that the AI would disrupt this business, and so far the data shows that this business continues to grow, and over the last 2 quarters, this business re-accelerated in growth. Breaking down their performance in business segments, we have the subscriptions, platforms and devices growing by 21% year over year. Google Network declined by 3% year over year. YouTube Ads grew by 15% year on year, and as we said, Search grew by 15%. Operating income was $33.5 billion when you add back the one-off fine from the EU competition law of $3.5 billion. It grew by 20% year on year. Google Cloud momentum continues to be strong. The revenue grew by 34% and stood at $15.2 billion. Their operating income was $3.6 billion and the operating margin was 23.7%. And as we know from Amazon's and Microsoft's cloud businesses, this operating margin should continue to climb towards 30 to 40%. To help you visualize Google Cloud's momentum, this chart shows their revenue on a quarterly basis going back to December 19. 5 years ago, the revenue was $3.4 billion, and today is $15.2 billion, an increase of 4 to 5 times. And the story becomes even more crazy when you look at the revenue backlog, as it jumped by 82% and stood at $157.7 billion. And keep in mind, this backlog doesn't include the most recent deals they've done with Anthropic. So next quarter, this will go way higher. And as we can see from the stock price, following the earnings, the stock price popped and finished the week up by 6.2%. Next up, we have Amazon. They beat on top and bottom line. AWS revenue reaccelerated as it grew by 20% year over year. Management highlighted that they increased their capacity by 3.8 gigawatts in the last 12 months, expect to add more than a gigawatt by the end of the year. Their cloud capacity doubled from 2022 and they want to double it again by 2027. Trainium 2 is a multi-billion-dollar business, increasing by 150% quarter on quarter. It's better when it comes to price performance versus competitors. And Trainium 3, which will come out very soon, is 40% better in price performance metrics than Trainium 2. Management also highlighted that Trainium 3 will be available to wider customers. And the last point I will make is that their year-to-date CapEx was $89.9 billion and they mentioned that 2026 will see higher CapEx numbers. Their net sales increased by 13% to $180.2 billion. North America revenue increased by 11% year over year to $106 billion. International segment sales increased 14% year over year to $40.9 billion. And AWS, as I mentioned earlier, increased by 20% year over year to $33 billion. And lastly, operating cash flow increased by 16% to $130.7 billion for the trailing 12 months. AWS revenue reacceleration was obviously the reason that the stock price popped following the earnings. We can see from this chart here that AWS revenue reaccelerated for 2 consecutive quarters and the growth rate of 20.2% was last seen in December 2022. And looking at the AWS remaining performance obligations, they grew at $200 billion or $5 billion compared to the previous quarter. This chart shows the cash from operating activities for the last 12 months sitting at $130.7 billion and capital expenditure sitting at $120 billion. This chart highlights the fact that the management is leaning in growth opportunities as they generated $131 billion and invested $120 billion, which is the largest CapEx amount when you compare it with its peers. And this table is one of my favorite tables that Amazon provides. Online stores grew by 8%, physical stores by 7%, third-party sellers by 11%, advertising by 22%, subscriptions by 10%, and AWS by 20%, and other segment 7%. And as you can see, the high margin businesses, which is third-party sellers, advertising, subscription, and AWS, are growing faster than the lower margin businesses, which is online stores and physical stores. And as I mentioned earlier, after the earnings report, the stock price popped and finished the week up by 7.4%. Okay, now I'll provide some key comparisons that help me and hopefully you digest all of this information, focusing on cloud revenues, CapEx, and valuations. Starting with cloud revenue, we have AWS at the top, Google Cloud, and Azure here. Their growth rates were 20.2% for AWS, 33.5% for Google Cloud, and 40% for Microsoft. The last 12 months revenue was $122 billion for AWS, $53 billion for Google Cloud, and unfortunately we don't have the split from Azure as Microsoft is reporting their intelligent cloud division as one line item. However, last quarter management said that their Azure annual run rate is $75 billion. So if we assume the last 12-month numbers and the Azure number we have here grow by the growth rates that they achieved this quarter, we have next year AWS revenue being $157 billion, Google Cloud being $71 billion, and Azure being $105 billion. So the key message for me is the following. A 20% growth of AWS and a 40% growth of Azure leads to only a difference of $5 billion. AWS brought specific capacity online for Anthropic, which is growing fast, so I expect AWS growth to continue with the current momentum. And given that we had comments from both Microsoft's and Amazon's management that they want to double their capacity by 2027, and the fact that AWS remains the leader today, I expect AWS to be the leader 2 years down the line. Moving on to CapEx, we can see from this chart here, we have Amazon in orange, Google in red, and Microsoft in blue. Since Q2 2020, Amazon's CapEx is much larger than Google's and Microsoft. This reinforces the idea that AWS will remain the leader as Amazon CapEx is much higher than Microsoft's. And I guess the second point is, the markets today are punishing Amazon for the current CapEx as they are kind of impatient, but patient investors stand to benefit as these investments today will bear fruits down the line. And lastly, looking at relative valuation, I look at the price over operating cash flows as a multiple. The reason I look at operating cash flow as a multiple is because we're going through these investment cycles, pushing free cash flows down for these companies. But once these investment cycles finish, their free cash flows should explode. We have Microsoft sitting at 26.6 times, Google at 22.5 times, and Amazon at 19.6 times. And looking at the forward price to operating cash flow metrics, we have Microsoft at 22 times, Google at 19 times, and Amazon at 14.5 times. So, if I had to invest in only one stock today, which company would I choose out of these three? The answer is Amazon, and let me explain why. Amazon remains the leader in cloud with AWS, and they are planning to double their capacity by 2027. Their Trainium chips are a multi-billion business, and price performance metrics will eventually matter. When money becomes a bit tighter, price performance value will matter. The current Anthropic project they completed with Trainium 2, it's a flagship project that I expect will attract more customers down the line, and they are planning to release Trainium 3 to wider customers. Amazon has a lot of other bets, and the one that I'm mostly excited for is Project Kyber, their broadband service, and I think it will bring incremental cash flows to the business, but also the possibility of cross-selling across various businesses. I talked a lot about this in my previous video, so go and check that out. Their advertising business, which is growing more than 20%, is still in early days. The higher margin businesses are growing faster than the low margin businesses, which means higher multiples for the business as it becomes more predictable. And the next quarter, Amazon will be overtaking Walmart in revenue, and I think will be the first company to reach $1 trillion in revenue soon. However, all of this is not even the most exciting part for me. The most exciting part is robotics and automation. Over the next 10 to 15 years, this will be the new tailwind for Amazon, and current conditions today suggest that Amazon stands to benefit a lot from robotics and automation. A few facts around this: Amazon already employs over 1 million robots, and they are investing heavily, as management clarified in their last earnings report. They have a massive amount of people employed, employing over 1.5 million people, which means opportunity to automate and reduce their workforce relative to the size of the business. We recently had this article suggesting that Amazon is looking to cut 600,000 roles through automation based on leaked documents that came from Amazon. This article was misleading. What Amazon is aiming to do is grow without hiring additional people. So they want to grow and lean into robotics and automation to help them with their margins. Amazon is at a scale that even small improvements in margins will be significant for the business. Their total revenue for the last 12 months sits at $691 billion. You might say, well, robotics and automation would apply to the for business. Okay, let's focus only on the online stores. Their revenue for the last 12 months was $262 billion. A 1% margin improvement is $2.6 billion in profits. A 10%, 26 billion, and a 50% improvement in margins, 39 billion. Now, I'm not claiming that I know where we are going to land in margin improvements, but that's the scale here. And Amazon has demonstrated that they are able to deploy robots, as they're already deploying over 1 million robots. And as this number increase, I expect the margins of the low margin businesses to expand. Well, you might say new competitors and firms will enter this arena and Amazon won't benefit that much from it. Well, let's make an assumption that Google and Microsoft, two very highly profitable companies, want to enter this arena. I think Amazon still has the upper hand on this. I shared this graph earlier in the video. This is the cash flow from operating activities and capital expenditure for the last 12 months. Amazon generated $131 billion and their CapEx was $120 billion. Amazon has no dividends or share buybacks to complete. Let's look at Google. They generated 151 cash flow from operation, but at the same time, they have to pay around $65 to $66 billion in share buybacks and dividends, which means cash flow from operations, less dividends, less share buybacks is only around $90 billion. This compares to $120 billion with Amazon. Let's look at Microsoft. They generated $147 billion in cash flows from operations, and they have around $45 billion in share buybacks and dividends. Again, when you net this off, the amount is around $100 billion, which is nowhere near the $120 billion that Amazon is already spending in CapEx today. And the final point on why I think Amazon is the best pick today out of the stocks is valuation. The forward price to operating cash flow multiple is 14.5 for Amazon, 19.2 for Google, and 22 for Microsoft. Once this investment or CapEx cycle finishes, which by the way it's a management choice and I call this the management switch, the stock price multiple should increase and I think will outperform its peers and the wider market over the next 5 years. And to finish off and full transparency, let's look at my investment portfolio. The investment value sits at £16.8 thousand with a return of £2.4 thousand or 17.1%. And my allocation is 43.5% in Amazon, 26.7% in Google, 13.3% in S&P Global, 9.2% in Adobe, and 7.3% in Fair Isaac. That's it for this episode. Let me know if you like this type of content. Leave a like, subscribe to the channel, and I'll see you in the next one.